Okay. Good evening, everyone. Welcome to the Medventions Lecture Series. Last week, we started the discussion on medical device investments, and we had Brian Bloom walk us through the how to kind of approach venture capitalists and how venture capitalists actually look at innovations in the medical device field and how these actually compare to the biopharmaceutical industry as well. Today, we are going to be looking at the more broader picture on the landscape for financing in medtech and the different types of investors and investments in medtech and their implications on the development process and on the company. So I'm very pleased to be introducing our speaker today, Stefano Picone, and I would like to actually take this opportunity to thank him because he has been generously contributing to our Medventions program, has been participating in all our innovation events and advising our innovation teams on many finance-related issues as well. Stefano is the Director of Finance at Conavi Medical, a Sunnybrook spinoff and a Toronto-based medical device company that develops image-guided technologies for the use in minimally invasive procedures. Stefano oversees the day-to-day financial operations and share responsibility for fundraising, business development, and operations at Conavi. Stefano is actively involved in the early-stage life sciences ecosystem in Toronto and Sunnybrook. He participated in the clinical needs finding competition, which was part of the annual Innovation Day back in 2015. And he, as I mentioned, he has been continuously participating in our lecture series for the past 2 years. Stefano is a graduate of the University of Toronto and is also a member of the Institute of Chartered Professional Accountants of Ontario. Stefano, thank you very much for being our guest lecturer tonight.
Great. Thanks, Ahmed, for that very warm introduction. And also, thanks, Ahmed, for all you do in putting together this Medventions program. I'm a huge supporter because I believe in the potential of the Canadian medical device industry, and I believe that Medventions has a huge role to play in the industry. So I think this is my fourth or fifth time speaking at Sunnybrook. I can't recall. But each time I come, I like to talk about a topic related to finance. It's a little bit different. So today I'm sort of just going to give you a sense of the landscape of different sorts of people that invest in medical devices and also the different types of investments you would encounter. So just to give you a high level sort of agenda, I'm just going to give you some quick thoughts on raising money and then go into, again, the different types of medical device investors and the different types of investments. The types of investments, that section is going to sort of presume a little bit of knowledge with regards to capital structures of companies, equity, etc. So my apologies if I do lose anybody in that area. And then I'm also at the sort of conclude with what I believe to be the cardinal sin of medical device investing, which I believe that medical device investors do wrong, and then provide some resources at the end. If you have any questions at any time, please feel free to raise your hand, holler, throw something at me, etc. So some very quick thoughts on raising money. Nearly all of what I know about raising money, I've just learned from doing. I've been in the life sciences industry for probably about 6 or 7 years now. Prior to that, didn't have a lot of experience in raising financing, so it's just been sort of a crash course. And even though I am a chartered accountant, nothing what I learned going through that process taught me anything about raising money. It taught me about how to do accounting and audit and tax, etc. But this has all been a very organic experience. One thing that I would strongly recommend anytime you're raising money is to, remind yourself or be mindful of the fact that there are a lot of legal implications, and it's always good to have a very qualified lawyer. So not your friend that just graduated from law school, and not a family lawyer that's the person, your neighbor down the street is someone that, because there are a number of traps with regards to raising money in the legalities, so be very mindful of that. It's always helpful when you're raising money to sort of to have spent time on the other end, which is having invested money. And there's these things called the public markets, exchanges, equities, et cetera, where you can actually invest and you can learn, okay, you sort of go through the process yourself of figuring out, okay, let's say there's a publicly traded medical device company. Would I invest in that? Looking through the regulatory filings, press releases, et cetera, looking at it from that perspective. That's something that I used to do extensively. I don't have as much time now because Conavi is quite a consuming job, but I learned a lot about raising money just from the process of saying, if I am myself an investor, what am I looking for? I like to refer to the rule of 4 when raising money, which is that it's twice as stressful and takes twice as long as you would anticipate. Actually, it's certainly not for the faint of heart. So always sort of keep that in mind, that it is certainly a grueling process and requires a fair amount of perseverance. I've never felt, though, that raising money is actually an accomplishment. I believe that returning money to investors is, and also helping patients is. So I'm not a big fan of, we raised X amount of dollars, let's celebrate with a press release, etc. So that's sort of a little bit my mentality. And lastly, one thing to be mindful of, again, going back to this experience of, having invested myself and having seen people invested, is you can certainly be wrong. And if you think about how an investor could be wrong, just think about a truth table, for example. And, on the sort of the one side, you have whether the company was actually successful or a failure, and the other one was, was it or was it not funded? So ultimately, what an investor is trying to get to is they're trying to invest in those true positives, right? They're trying to put money in companies that will eventually succeed. What they definitely don't want is a false positive, where they end up putting money into a company where it's absolutely going to fail. In many cases, they're going to trade off having fewer false positives by not investing in companies. So they're going to try to avoid they'll trade off fewer false positives for more false negatives, which is not putting money into a company that succeeds. And then lastly, it's avoiding putting money into companies that fail, and that's sort of a true negative. Anyways, so I guess the moral of the story here is that investors can be wrong in 2 ways, both putting money in companies that fail and not putting money in companies that succeed. So just something to be mindful of. Anyways, with regards to the landscape of the types of investors, I've sort of broken it down into these broad categories, and we'll go through each one and sort of the pros and cons of each. Friends and family, angels, family offices, VC firms, strategics, and public sector. I would imagine most of you would have heard of all of these. So we'll start with friends and family. And, it's interesting because, I mentioned legalities, and the Securities Act of Ontario, which actually governs how companies in Ontario raise money, has a definition of really what is a friend or family. And it sort of, it only covers people that are certain immediate family members, so not your third cousin twice removed, close personal friends, and close business associates. And in some circumstances, you actually, as part of the subscription agreement, have to demonstrate that. So just be aware that this friends and family is not sort of a blanket thing where you can go legally, technically raise money from. There's actually sort of a legal definition of that. So if you look at the pros of raising money from friends and family, the first is that they tend to be readily accessible, and they're probably the most willing to invest on the basis of character relationships alone. So they know you, they trust you, good intentions, etc. I'll put some money in. And they're likely going to be the potential source of first funding, maybe your first $5,000, $10,000, $15,000, etc. The cons, and I've sort of witnessed this personally, it has the potential to really strain or complicate a relationship. You don't want to be in a circumstance whereby friend or family member gives you money and then all you ever talk about is the company, or if something goes wrong, then it basically, you no longer have a relationship. I think it's important everyone has their own values, but you wouldn't want to put yourself in a circumstance where that relationship eventually could get compromised. Friends and family are unlikely to be sophisticated, both in terms of what you're doing, but also the investment in the startup process, and maybe as part of giving you money, they might give you some advice that could lead you down the wrong path, et cetera, et cetera. And obviously, they're likely limited in the amount of capital that can be provided, unless you come from a very wealthy family. Again, it's probably limited to in the neighborhood of $10,000, $15,000, $20,000, et cetera. So that's sort of how I look at raising money from friends and family. So the next is angel investors. And it's interesting because, again, the Ontario Securities Commission, or the Securities Act of Ontario, has a very specific definition of who is an accredited investor or an angel investor. And it's pretty much somebody individually that meets one or more of these tasks, which is they have income greater than $200,000 in the last year, and they expect that same amount in the upcoming year, or with their spouse is in excess of $300,000. They have financial assets, net of liabilities, greater than $1 million. So financial assets would be things like your retirement plan, stocks, cash, et cetera. It does not include your house. Or you have net assets greater than $5 million. So there's actually some pretty strict criteria in terms of who qualifies as an accredited investor. So the pros of raising money from these groups is actually about 1% of the Canadian population would qualify. And that's in the neighborhood of about 300,000 people. That doesn't mean that all of them would want to invest, but that does mean that at least 300,000 accredited investors are out there. A substantial number of these people would be practicing physician specialists. If you look at average physician compensation in Ontario across Canada, it typically exceeds that amount. So that's good. And there's probably about 40,000 specialists across Canada. And typically these are the sort of people that are capable of writing checks 50, 100, 250,000, perhaps up to $1 million. They do have that financial capability. Typically, they will make the investment in the context of an overall portfolio. They're not going to give you all their money, but they may give you 5-10% of their portfolio. So the cons of raising money from angels is they're extremely heterogeneous group. Every angel is a little bit different that you interact with. They all have different sort of levels of knowledge, sophistication, motives for why they're doing this, etc. So it's not like, well, I went to one angel and therefore what I learned through that experience I can necessarily translate over to another. They are reasonably accessible, although in a lot of cases they prefer warm introductions. One of the ironies about so actually there's an expression in Italian, and I don't speak Italian, but it's basically that being beautiful. The expression is being beautiful is a curse because then nobody will love you for who you really are. Sort of translates to having money. I mean, if you have money, everyone's going to want to talk to you, right? And they're not going to want you because they're not going to want to talk to you really because of who you are. They just want your money, right? So you'll find that people that do have money tend to shield themselves, right? So groups such as this, which can fall into this category, they want a warm introduction, whether it's from their lawyer or somebody else they trust, somebody they've done business with, etc. So it's not something necessarily that you can try cold calling, but if you can get a warm introduction, that's a little bit more favorable. And just going back to physicians, I think there are special considerations when raising money from physicians. You might be working on a medical device for a certain specialty, but you'll have to think, I mean, could, again, that physician investing potentially, sort of compromise downstream, create some sort of conflicts of interest, et cetera. And, if you are a physician, for example, founding a company and you're actively involved, you would want to think, well, would I want to raise money from my other colleagues? Again, thinking that if something went wrong, then that might impair my professional relationship, right? So there are some special considerations there. But with that being said, there are a number of medical device companies in Toronto that have raised, and in Ontario across Canada, that have raised angel rounds from physicians that would ultimately be one day their customers. So there's also these things called angel groups, which are sort of formal angel networks that are organized. They're membership-based. Typically, the members have to pay a fee, maybe a couple $1,000s per year to join. They sort of collectively review and refer to one another investment opportunities. And if you want sort of the list of angel groups, you can go to either of these links. Angel Investors Ontario will give you the list of Ontario angel groups. I believe there's about 15. And then NACO will give you the ones all across Canada. I think there's probably about 60 across Canada. So that's a way. And typically, those angel groups will have a formal process. You might have to apply online, or you might need a member to sort of act as your champion to introduce you to the group. And then typically they'll sort of review applications. Then they'll have sort of a meeting where they'll ask companies to come and present. And then as a group, they will decide how they want to proceed. So angel groups tend to be very organized, systematic, structured, sophisticated. They actually have staff that are paid to coordinate these things. They really review deals with the intent of forming a syndicate. They're good if you go to them and you say, okay, I need $1 million or $2 million. Even though each investor is only responsible for writing a check for maybe $25,000, $50,000, they'll try to pool everybody together so you have enough money. And usually there is no or nominal fee to present. I'm sort of weary of any sort of groups that require a fee to present to them. Typically, the groups listed on the Angel Investors Ontario website or NACO Canada website, I believe, do not require any sort of substantial fee to present. The cons is, again, typically it requires really to get into the angel groups. They see a lot of deals, and they see deals from the IT space, fintech, all over. So it really requires a relationship with a gatekeeper, somebody who's a member, somebody who probably understands your technology to provide the introduction and to make the rest of the group comfortable. They really tend to have a bias towards companies that have revenue and tend to have lower capital requirements. So, which usually is not a medical device company. It probably would be, an IT startup that maybe has $50,000, $100,000 in revenue, and over its life might only require 5 million to really scale. They tend to have a bias. They're really sort of cautious towards deals where there's going to be a lot of follow-on financing, because they don't want a VC or somebody else to come in after and squash them down with preferred shares or something. And they, at least in my opinion, tend to have some questionable investment heuristics. They're almost always fixated on what your pre-money valuation is. They don't, like for me, an investment is always sort of judged by what the potential annualized rate of return is. Doesn't really matter what the valuation is, as long as that valuation can support an annualized rate of return. So they typically do not look at companies with pre-money valuations greater than 3 million. They have a very, very low bar in that regard. So they're good to go to if you are raising a small amount of money early on. But if you think about it, if you're raising 1 million on a $3 million pre, you just gave them 25% of your company. So something to think about. Family offices. So some of you may have heard of family offices, and they're really sort of firms that manage the investments and finances on behalf of one or more ultra high net worth families. And typically, in order to justify having a family office, you need at least $100 million, because it usually requires about $1 million per year to run. So the pros of working with family offices is that they're professionally managed. Typically, they will have their own investment managers that are actively managing the portfolio. They tend to have a very entrepreneurial mindset. The people that have a net worth in that range, other than those that inherited money, were usually people that started businesses and were very successful. So they're sort of receptive to entrepreneurs, and they are capable of investing very large sums. The challenge with family offices is that they are incredibly discreet. They are almost very, very, very difficult to find. Anybody that does have a family office, they are not advertising it, because again, they don't want people bombarding them with information and pitches and things of that nature. So it really requires a very, very warm introduction. Access is extraordinarily difficult. And the decision-making process can be highly secretive and opaque. They really don't owe disclosures to anyone other than themselves. Where you might find with a VC, where if they choose not to invest, they might provide some feedback for the purpose of just trying to maintain a relationship or trying to maintain goodwill in the community. They don't want people saying bad things about them. For a family office, they can be incredibly, incredibly discreet. You have absolutely no idea what's happening behind closed doors. So that's family offices. VCs, which we're all familiar with. So, what is a VC firm? It's really a firm that manages, I guess the formal definition is it manages one or more closed-end funds on behalf of limited partners or a defined period of time. So closed-end fund basically means that they assemble a bunch of money into fund and then they close it off. It's unlike a mutual fund where maybe it's open, you can sort of join or leave over time. And again, it has a defined period of time. So that it's expected that within 10 years typically, they have to return money to their own investors. And who are their investors? It's typically endowments, retirement plans, sovereign wealth funds. Within Canada, the province of Quebec has been very active in terms of giving money to Quebec venture capitalists to invest. Typically, it's in companies in Quebec. But that model has worked very well. And they're compensated using what's called the 2 and 20 model. So every year they sort of get 2% of assets under management, plus they get 20% of what they ultimately return. So if you're managing 100 million, that means that every year you get a $2 million management fee. But that 20% return is calculated after you deduct the management fee. So I think you would have to earn, I forget, doing the math. If you earned, for example, if your $100 million portfolio earned something, a little bit less than 18 million, whatever the math is, like you wouldn't get a return, right? So it's only once you've hit that watermark that you actually get to start earning your 20%. The pros are, typically when a VC comes in, they're going to come in with some deep pockets and the intent of capitalizing the venture until an exit. I mean, they're not going to give you typically a $5 million check and then say, go find the rest. They're going to invest with the intent of supporting you throughout the life of the venture. They're obviously very professional and experienced. They have a lot of expertise and access to networks, which is typically the idea when you invest, where you bring on a VC is you're bringing them on for more than just their money. You're bringing them on for their professional experience. And their due diligence process is really extensive, which is actually great for the company because it really shows you what your flaws are. They're going to dig all through their IP. They're going to dig through all your legal agreements, which is why it's great to have a lawyer from day one. They're going to dig through your finances, pretty much everything. They're going to want to make sure that everything is above board. Now the cons, they have a limited window to invest and realize a return. Typically, VCs, when they have a new fund, they will only invest probably in new companies within the first 3 years, and maybe reserve the next 2 to 3 years for follow-on financing. And then the remaining 4 years of the fund is just with the intent of harvesting. There's a very limited window. So a lot of times raising money from a VC comes down to timing between your company needing money and them actually having money. But with that being said, a lot of times VCs will raise money already knowing the companies they want to invest in. So even if a VC isn't actively managing a fund, it's a good idea to sort of have a relationship. They tend to be the most demanding with regards to valuation and control of a venture. And that's because they have a lot of money and they have a lot of professional experience, and they feel that is highly valuable. So if they're giving you something that's highly valuable, they want a lot in return. Right now in Canada, there's probably only about 8 VCs that invest in medical devices, and you're only going to see 3 or 4 deals per year at most. It's something where if you do want to go down the VC route, you're probably going to have to think international. But with that being said, international VCs often don't invest outside their own geographic network. And that's not just sort of, a VC saying, well, I don't want to put money into a company in Canada, like a US VC. It's more like, I don't know people in Canada. Typically, VCs rely very heavily on their networks to sort of vet companies and people. And so if they don't know a lot of people in a certain area, they don't really have that network to be able to go and say, well, what do you think of person so-and-so? What do you think of their company? Because ultimately investing in this sort of, in a medical device startup is very relationship-based. You want a certain assurance both with regards to the company, but also with regards to the people that are running the company. So that's the reason why you don't see a lot of US VCs come to Canada. If they do come into Canada, they're syndicating with a Canadian VC that can say, oh yeah, I followed this company for 3-4 years, etc. By the way, any questions? Good. Yes, Zaid.
4 deals, is that for only 8 VCs per year, or is that 4 deals per VC?
So the question is that 4 deals per year or 4 deals per VC per year? It's the former. And they are more active in life sciences as a whole, but they do a lot more deals in sort of the pharma space, in biotech. Pharma and biotech are much more conducive to VCs because of that sort of limited time horizon, and also because there's a much larger pool of acquirers. And I'm not sure if I mentioned this on the previous slide. VCs are very biased towards companies they can invest in that there's an eventual acquisition. A little less interested in companies that will go public. Again, the reason being is that you can sort of sometimes invest in a company and build to buy. You can build a company with the intent of figuring out a way of selling it from day one. With that being said, though, there's a lot of clinical stage biotech companies that are going public in the US, although I think a lot of them are still being positioned ultimately one day to get acquired by one of the big pharma or biotech companies. So, but yeah, the deal flow, or the number of deals being done in Canada a year in medical device space is not great right now. So, so strategic investors. So who's your strategic investor? There's somebody that provides financing in consideration for one or more strategic rights. And that right might be co-development. We want to work together on developing a product. Maybe it's co-marketing. We're going to sell something together. It's distribution. I want to be your exclusive partner in country X, or even supplying product to you. So there's any number of strategic groups you can go through. It's a matter of thinking of your value chain. How do we go all the way from the idea all the way to the customer? Who else is involved that I have to work with? So the strategic investors of all the groups, even VCs, are probably the most likely to have a nuanced appreciation and understanding of your business. And that's because, again, they exist along the same value chain. So they understand how products go from sort of conception to customer. They tend to view the transaction a little more as a partnership, which means that they're looking for sort of long-term success. They're less interested in buying you and then trying to flip you and then returning money to their investors as a VC might. They're really thinking about long-term success. And in many ways, they extract more value from the actual strategic right they get than the financing. The financing to them is really just a way of locking you up into exclusivity. And because of that, the investment terms are usually much more favorable than a VC because, again, they are willing to give you lower terms in consideration for the strategic right, which is great value to them. So the cons of dealing with strategics is that it can be really complicated. It's generally more difficult negotiating two things at once than it is just negotiating a straight up financing. It's heavily reliant on deal champions. So which means that you need, if you're trying to exercise a strategic investment, you need somebody at that company really trying to push that deal through. You can't just rely on the company as a whole. You need sort of a counterpart on the other side. And sort of the one good thing about VCs is typically anytime you're dealing with a VC firm, you will have that partner leading the deal. So if you're ever dealing with a strategic, large medical device company, et cetera, you need somebody on the other side who's really pushing it and who you can rely on to move the deal forward. It's the sort of thing where typically in investment, the investor is doing due diligence of you. For a strategic investment, you actually need to do due diligence of the strategic partner because you need to make sure that they are capable of, they're a group that's that you want to do business with and that you're prepared to work with for the long term. So that's extremely important. And strategic investments and partnerships are really likely to fail if there isn't some sort of sense of trust. And a lot of that trust is built, I would say, at sort of the management level in terms of, both management teams trusting one another. So if you ever have a circumstance where there's a turnover in management team, either from your side or their side, that could sort of, I wouldn't say necessarily put the relationship in jeopardy, but make things a little bit more complicated. So yeah. And then lastly on the list is the public sector. Which is sort of any money you can get from a provincial or federal government agency. There are a number that provide funding to early stage companies. And the funding can be in the form of grants or it can be in repayable assistance. So maybe it's a loan where there's little or no interest. So the pros, typically government money, low cost of capital because their major concern is helping companies because that stimulates a social benefit. The use of funds is typically directed. They want you to do specific things, which is actually a good thing because they're trying to say, all right, we're giving you this money, but we want you to accomplish X, Y, and Z. And it's usually to support hiring, to bring people onto your team. And again, there's a mandate to provide some sort of social benefit. So as a result, they really, really like healthcare innovation. There is definitely a bias for these grant programs to support healthcare because, it sort of combines the commercialization of science, it helps patients, et cetera, et cetera. The cons, government funding programs can be, they're heavily reliant on provincial and federal budgets, so whoever's in power. And you're probably going to see at the provincial level, because there's an election next June, that probably, I would say, starting, if it hasn't already started, early next year, there's going to be a complete shutdown in terms of grants or a slowdown. If the money's not already committed, there's going to be less money coming out. The programs are obviously extremely bureaucratic. There's typically a lot of hoops to go down. One group that we worked with that I find to be very good is NRC IRAP. I find that their process is very much like the private sector, but other sort of groups that we've worked with tends to be a little bit more what you would expect of government. And the public sector operates at a much slower and cautious pace. I mean, if you think you're a startup and you're working 70 hours a week, and you have people in government that work 35 hours a week, you're essentially moving twice as fast as they are. So sometimes they can't always keep up. So something to consider there. Anyways, that is the sort of the discussion of the different types of investors. Again, I'm going to take a pause so I can drink some water and also see if there's any questions from the audience. So, none? All right. So this is the area where I seriously hope I don't lose anyone. And this is sort of talking about the different types of investments. And again, I am presuming that people here have a little bit of a finance background or some exposure to securities, but I still try to keep things relatively high level. So in terms of the ways that people can put money into companies, there's really only a handful. Broadly, there's really just equity and debt. But even then, there's this thing called hybrid equity, which is actually the most common, which sort of combines the elements of equity and debt, which are convertible preferred shares and convertible debt. So whenever sort of I'm looking at an investment, I always like to look at it sort of in three lenses. The first is every investment can be distilled into what it means with regards to economics and control. So economics is sort of, how much of the company do I own as an investor, or as a company, how much am I giving up? And what does that mean in terms of, if the company were to sell or go public or whatever, realize an exit, who gets what in terms of the amount of money? And that's a lot predicated on valuation. And typically when people are negotiating investment, all they fixate on is valuation, which is important. But you also have to consider control. When investors come in, they have the ability to even vote on and dictate certain decisions of the corporation. So you want to make sure that you are not giving up sort of unilateral control to an investor. And typically, if you watch Dragon's Den, I like to think of Dragon's Den is to entrepreneurship as like ER is to medicine, or Grey's Anatomy is to medicine. It's sort of like a gross simplification. And you always hear about like 51% equals control, which is true, but also completely untrue. So it's sort of going down the right path. But again, there's a lot of different elements of control. And it's important to think, when I take investment from an investor, what power or influence can they exercise over the organization? I always like to think in terms of risk and reward. What is the investor's potential downside? What is their upside? So that lens. And then lastly, it's important to consider, well, I have 1, 2, 2 there. Great. It's supposed to be 1, 2, 3. So there are so many investments are like snowflakes. No two are alike. They're similar, but no two are absolutely alike. So it's important to think that just because I saw this investment or this company did something this way, there are so many different variations, innumerable variations in the way that people can invest. So let's start with equity, which is really the simplest type of corporate ownership, which is probably what most people are familiar with. And really, common shares, which is sort of the first category of equity, can be sort of broken down into two things. It's sort of proportionate to the value of the company you own. So you own 10% of the company's worth 100 million. Technically, your shares are worth 10 million. But it also sort of equates to voting rights, which is the ability as a shareholder to vote on certain issues. Certain resolutions of a corporation will require shareholder consent. Although there are plenty of exceptions. A lot of companies, and I believe Facebook, if they not only have this, are moving towards this, are non-voting shares. So only the founders are eligible to vote on certain matters. All other shareholders are ineligible to vote. Great thing about common shares is you're eligible for dividends and capital appreciation. You own a stock, think about it like owning a stock on the public markets. It can go up in value, you can get dividends, etc. It can also go down in value. One of the downsides about equity, though, is the event of liquidation, which is either the company's assets get acquired or there's a bankruptcy. You're basically the last to get paid. The first to get paid are creditors, and then there's these things called preferred shareholders. So you're sort of the last on the ladder to get paid in the event of a liquidation event. And usually, common shares are actually more desirable for the company than the investor. And the reason is because common shares make sure everybody's sort of, well, if you think about common equity, it's sort of, you think about the word common to everybody, equity, fair. It's actually, I believe that's where they came up with the word. Whereas other forms of investment actually have the ability to bias or favor one investor over the other. And I'm actually going to give you some examples of that. So typically equity is best at keeping everybody on the same level and making sure that everybody is aligned in terms of making sure that the corporation is doing what's best for investors. There's something else that you'll probably see when you're raising money. It's called warrants. And that is an option for an investor to purchase a security at a certain price before expiration. And typically they're added, so an investor comes in, they'll buy some common shares, you'll give them some warrants, typically as a sweetener, and there's no additional consideration. So one thing you'll see, typically the language, sometimes public companies will issue warrants when they do a financing, you'll see this language. So you'll see, let's say I purchase 100,000 units of Led Zeppelin Inc. at a price per unit of $1, that gives me one share, and it also gives me 1/2 of one warrant. And each warrant gives me the right to acquire one common share at a price per share of $1.20 within 36 months. So basically, for $100,000, I got 100,000 common shares. Then I also got 50,000 warrants, which let me acquire 50,000 common shares within 3 years. And if I want to exercise any one of those warrants, it's $1.20. So let's say within 36 months, the price of the share goes to, I don't know, $2. Then my warrants, my options are in the money by 80 cents. So I've done really well. So the thing about warrants is that there's only upside, right? There's no downside. You do not have to exercise them. And you'll see in a lot of cases, investors will ask for warrants because they want a sweetener. They want more upside. Hopefully I didn't lose anybody with that. But that is very, you will see warrants. They are extremely, extremely common. So debt's another way that people can put money into companies. So it's money loaned by one party. That's the creditor to another, the debtor. And there's contractual terms with regards to interest, principal repayments, et cetera, et cetera. Some debts are secured against the assets of the corporation. So basically what it means, it's comparable to a mortgage. If you default on your mortgage, the bank gets to repossess your house. If you have a secured lender and you default on your repayment obligations, then that the creditor can repossess whatever asset is secured against the loan. It might be, I don't know, inventory, it might be receivables, anything that's an asset to the corporation. And it's quite common that, lenders will give companies money and ask for security and consideration. So one of the things about being a creditor is that you're the first that pay. Particularly secure creditors are at the top of the list in the event of a liquidation. So whether it's a bankruptcy or sale of assets, etc. However, your rate of return is pretty much limited. So if you think about things in terms of economics, I talked about economics of control. From a creditor standpoint, your economics, your rate of return is always limited to whatever the interest rate is. There's several exceptions to that, but for the most part, that's the general rule. And even though creditors they're not like shareholders, they don't have voting rights, they can still exercise control over the corporation by imposing covenants as part of the loan agreement. So they could say, in order for this loan to be in good standing, you have to have $500,000 in the bank at all times. You have to not have a payables balance in excess of this amount. You cannot take on other debt without our consent, et cetera, et cetera, et cetera. There are a lot of different ways that creditors can exercise control over an organization, and in some ways more so than a shareholder could. With that being said, given the risk of an early stage medical device company, given that medical device companies typically don't have a lot of tangible assets, it's uncommon that you will find a lot of debt being issued. The one exception is typically if you have R&D tax credits, SHRED. A lot of banks or the EDC in Canada, et cetera, will loan against those. So they will give you money as you're waiting to receive your R&D tax credit. For a portion, they might give you 75%. And then that loan is secured against the R&D tax credit receivable. So essentially, if you were to not repay them, they would then be able to take possession of your R&D receivable. There's also this thing called venture debt, which sometimes you do see. And that's typically for growth stage companies or companies that do have some revenue and want to invest in manufacturing, property, equipment, et cetera. And that is essentially just debt plus warrants. So the creditor also would get the ability to purchase some equity later on as a sweep. And you see that is actually becoming increasingly more common for growth stage companies. So I've talked about equity and debt individually, and now I'm going to combine the two, hopefully in a way that isn't insanely confusing. Were there any questions? We're all good? We're all finance experts? Great. So I talked about hybrid equity. And this is, or hybrid securities, which are really debt-like securities that have the ability to be converted into equity or repaid. And they're almost universally favored by investors, although there is, again, the potential for misalignment. And the reason being is that for economic reasons, in a liquidation event, if you are a debtor, you start off in a debtor and then you have the ability to convert to equity, you rank ahead of the common shareholders. However, if you convert, then you're eligible for dividends and capital appreciation. And again, from a control perspective, you may also be able to impose certain lending covenants while also enjoying shareholder rights. So it gives people it limits their downside. I talked about risk reward. It limits their downside while allowing them to participate in upside, while also at the same time allowing them to exercise control. And control for investor can be very important because if they feel that they're making decisions, that might also sort of limit their downside and allow them to achieve more upside. So there's generally two types of hybrid securities. There are convertible preferred shares. And so preferred shares are shares that rank ahead of common shares with regards to liquidation. They accrue and accumulate a dividend. And then at some point, investors can either convert those preferred shares to common shares or ask for their money back. And convertible debt is kind of similar to convertible preferreds in that you have the ability to convert or get repaid. Rather than dividends, you have an interest. But the advantage of those is that they rank ahead of commons and preferred shares. And typically they are secure. What is the difference? And we'll sort of, you'll get a better appreciation of this, I hope, as we go through the examples. Debt can be secured. Preferred shares cannot. So a preferred shareholder can never sort of force you into receivership, which is them trying to take possession of their collateral, whereas a debt holder can. Preferred shares have something called a liquidation preference, and they can also be participating, which debt does not have. And I'll give you an example of this. There are also some potentially unfavorable tax consequences if you are a company and you issue preferred shares. So if you're a company, and I'm not going to go into this in great depth, but if you're a company and you issue preferred shares to a preferred shareholder, you could actually end up paying tax on those on the dividends to preferred shareholders. It's a very esoteric tax provision in the Canadian Income Tax Act. There's actually a bona fide reason why it exists, but it trips up a lot of people because they don't realize at the end of the year they could have a massive tax bill because they paid dividends. So I think it's occasionally good to have a very good accountant that's doing your taxes. So we talked about example of convertible preferred shares. I'm going to give you a couple scenarios. And the first scenario is sort of a scenario where everybody's supposed to win, and the second scenario is supposed to illuminate how an investor of preferred shares could come out ahead of somebody with common shares. So let's say that I purchase $500,000 of, so I get one preferred share of Led Zeppelin Inc. at a price per share of $500,000. And that dividend gets, that preferred share gets a dividend of 8% per year. It's not paid, it's compounded annually, and it accrues. And the preferred shares mature in 2 years. As a maturity, I can either request repayment or I can convert my common shares at a price per share of $10. And the preferred shares, in the event of a liquidation event, have a 2 times liquidation preference, and they're also participating. So what first scenario is Led Zeppelin does amazing, and the price per share at maturity in 24 months, company's done extraordinarily well. Price per share is $20. And I decide, okay, I'm going to convert. So what does that look like? So if you look at my principal plus accrued dividend balance, it's about $583,000. So that means that I can take my $583,000 and at $10 per common share, basically get 58,300 common shares. That means my value of shares within 2 years is about $1.16 million. So I've done pretty well. In less than 2 years, I've more than doubled the value of my investment. So that's a circumstance where everybody wins because the common shareholders, presumably, their price per share will go up. Scenario 2 is a circumstance where I do a lot better than everybody else. So let's say that Led Zeppelin Inc. has done reasonably well. Somebody comes along and says, okay, I want to acquire all the assets of the company. I'm going to give you $10 million. So I want to acquire the IP. I want to acquire your inventory, your receivables, et cetera, which is actually a relatively common way of acquiring a company other than just buying up all the shares. Let's say that $5 million is owed to creditors. And on an as converted basis, I would get, if I were to convert my common shares, I get 10% of the company. So the net acquisition price is $5 million. It's $10 million minus the $5 million we owe to creditors. I have a 2 times liquidation preference. So because this transaction happened only 1 year after I invested, my principal plus accrued dividend balance is $540,000, right? 8% of $500,000. But because I have this 2 times liquidation preference, before anybody else, any other common shareholders get paid out, I get paid out 2 times the balance of my preferred shares. Then I get to participate with everybody else. So what's left for the common shareholders is $5 million minus $1.08 million, which is what I got paid out because I have liquidation preference, which means I get an additional $392,000, which means in total, I got about $1.5 million on my $500,000 investment, even though I owned only 10% of the company, right? So I basically got 30% of the proceeds, even though I own 10% of the company. So there's an example where as a preferred shareholder, my interests are not necessarily aligned with the common shareholders, so it might be in my interest to try and force a sale of the company. So that's something to consider. And you will find in almost all VC transactions, they will ask for preferred shares with the liquidation preference, with participation rights, because in the event of a sale, they would do better than the common shareholders. So it's something to be really, really cautious of. Again, I talk about sort of, economics and control of different types of investment. Not all shares in the company are alike, and there are certain shares whereby that shareholder could ask for a transaction that is detrimental to other shareholders. So this is sort of an illustration of the misalignment. So misalignment can also happen with convertible debt. So another example, I invest $500,000 in Led Zeppelin Inc. Big Led Zeppelin fan, by the way, if anyone's kind of curious, in the form of convertible debt. And that debt accrues interest at 8% compounded annually. And once the debt matures, and the maturity is supposed to be, did I mention here? The debt matures once the corporation has raised an additional $5 million. And the conversion price is a 20% discount to the subsequent round of financing. This is very common with angel groups. They'll give you convertible debt, and then they'll say, we'll convert it the next round of financing. And the debt is secured against all the assets of the corporation. So let's say in 24 months, Led Zeppelin Inc. raises $5 million at a price per share of $10. So that means that, again, my convertible debt balance is $583,000. My conversion price, because I get a 20% discount relative to everybody else, is only $8. That means I get 72,900 shares, and the value of my shares are about $730,000. So I've done pretty well, again, on an investment of $500,000. So, and this is sort of the circumstance where arguably everybody wins. Scenario 2 is where only I win. And that's a circumstance where in 24 months, Led Zeppelin Inc. has violated one of my covenants. One of my covenants was, in the event any of the key management or founders leave, then I basically get to ask for my money back. So let's say in 24 months, Led Zeppelin doesn't have the money to repay me. Then I say, okay, I'm going to wind down the company. I have the ability because I'm a secured lender. And I appoint a receiver to come in and sell all the assets of the company. So let's say the receiver is able to get $600,000. They sell off the equipment, maybe they sell off some inventory, they sell off the R&D tax credit receivables, etc. So in this case, if net proceeds are $600,000, I get my full $583,200. And there's only about $17,000 to go to all the other creditors, the preferred shareholders, and the common shareholders. So essentially, everybody else loses. So this is a circumstance where, again, the misalignment, because I have convertible debt, nobody else does. It doesn't, not everybody is working in the corporation, all the investors are aligned towards the same goal. So that's really, really, really important, is when you do raise money, is to think, does this investor, because of the way their investment is structured, will they act in the interest of the corporation as a whole? And if you have a circumstance where you have a lot of different types of shares and a lot of different types of interests, things could get divisive very, very, very quick. When it comes time to the shareholders, there are certain decisions they're eligible to make, and yes, it can become a lot of conflicts. So anyways, those are my two examples with regards to preferred shares, convertible preferred shares, convertible debt. One of the other key considerations, interest on convertible debt is tax deductible, whereas preferred shares, the dividends are not. So one other consideration there. So your cost of capital for debt is a little bit lower because you get that tax deduction. Any other questions? Great. So coming to the end, and this is amazing. I didn't think there was any way I was going to be within time, but it seems like I am. So I'm going to ask, there's one thing that I consider to be the cardinal sin in medical device investing, and I see a lot of people doing it, and it sort of drives me bonkers. And I think anybody here who's a MedVentions fellow might be able to figure out. I know, Zaid, you're not able to answer this question because I've actually told you what the answer is. I'm hoping you remember, because I know you forget a lot of things I say. I'm just kidding. And he's shaking his head, by the way. So you're not eligible to answer, but I'm just curious. Sorry? So I'm just curious. Anyone want to take a guess what they think, I might think, the cardinal sin of medical device investing would be? And it's actually it would involve investing in a company that does the exact opposite of clinical needs finding. Does anyone want to take a guess? Nobody wants to take a guess. Do I have to offer a reward? Beer's on me. All right. So you find this a lot with investors, is they find sort of like a hot technology or hot theme, and they decide, okay, I'm going to sort of go after companies in that space. And there's no substantive evaluation of the actual technology. It's like, this is a hot field. I want to find a company within that field. So I rewind 5 or 6 years ago when I started in the life sciences industry. The big theme was, actually, let's go one step before that. This is a great example. The human genome being sequenced. Everybody thought that once the genome was sequenced, it was going to be this like unleash this tidal wave of amazing inventions, et cetera, because we finally had a sense of, okay, what are the base pairs of a human being? That did not come to fruition, right? There was still a lot substantively that was not known, and still is not known. If you think about, you might know somebody's gene sequence, but you don't necessarily know about what that might be expressed to. So there was still a lot of known that. But because it was so exciting, there was so much money poured into it. Fast forward, another really hot topic, point-of-care diagnostics, which 6-7 years ago was huge. This idea that, okay, rather than having your blood taken and sort of sent to a central lab, which is this big expensive place, it's really slow. We're just going to be able to take, your blood at a doctor's office, and you're going to get your results instantaneously. That did not come to fruition, because even though central labs are slow and expensive, they are incredibly accurate. And point-of-care diagnostic companies found out that unless you can deliver the exact accuracy of a central lab, you're not going to be able to compete, because no doctor is going to want to rely on a test that is less accurate than central lab testing. One company that sort of falls into this theme that you guys might have heard of is Theranos. Theranos had to raise billions and billions of dollars based on this premise that they could do a whole analyte panel with like a little drop of blood. And, it sounded like this great idea for little or no cost. Turns out they didn't really have any technology. A lot of people put money into it. I've seen other trends. I think wearables, some companies have fallen into that sort of category. Jawbone was one company that sort of had promised so much with regards to the wearables trend and failed. And another one that I think a trend that I see happening right now that I'm not really big on is artificial intelligence. I'm really cautious about it. And I know some people in this room might want to throw something at me. I think there are certain limited applications for artificial intelligence, but I think the field as a whole, particularly with regards to if you're doing something with clinical decision support, you better know the cause and effect. Because if you are giving a clinician a decision that is essentially a black box, I don't think, and there might be some clinicians in here in this room, I'm not a clinician obviously, but I don't know they're going to be comfortable with that. If your algorithm is essentially a black box, and the cause and effect that if you're just sort of spitting out a correlation, or the cause and effect is really not well known, I don't see how a physician is going to be comfortable with that. And I see a lot of parallels between that sort of field of technology and point-of-care diagnostics in terms of clinically some issues with adoption. That is my conjecture, and I could be wrong. I hope I am wrong about artificial intelligence, because it would obviously be great for the medical device and patients as a whole. I think the technology does have promise. It's just going to take maybe a little bit longer. And I think that the enthusiasm that exists right now is probably less than warranted. Anyways, this is my personal opinion. It certainly does not reflect the opinions of my employer. Caveat. So I just want to leave you with some resources. So I've obviously been here before, and each time again I try to think of something different to talk about. So if you want, you can go back, and these are sort of the links to some of my previous talks that I went through, and all sort of different finance topics. Books, specific with regards to the topics we discussed today. There's a really good book called Venture Deals, and it sort of walks you through all the things that I talked today with regards to the different types of investments, structuring them, et cetera, et cetera. So I'd really recommend that. You can get it for like $20 on Amazon. It's a really handy reference. It is a little bit, it's US-centric, and there are some things with regards to raising money in the US that don't necessarily apply in Canada, but it's still a very good guide. Two things that I subscribe to that are newsletters, email newsletters, are Term Sheet by Fortune and Pro Rata by Axios. And pretty much every day, they give you a list of all the VC, private equity transactions, et cetera. And then they also give some really good commentary just about the private equity and VC world as a whole. So you can actually learn a fair amount just sort of going through that newsletter daily. And the last thing is really public company filings. You can learn a lot by just digging through the filings of public companies. They have to disclose a lot. So for example, and these are the two sort of sites. Cedar is the Canadian version. So just type in Cedar into Google and you'll be able to find the website, and then you just look up the companies and you'll be able to find their filings if they're publicly traded. And also Edgar. Edgar is the US equivalent. And so for example, like an S1 filing is basically when a company wants to go public. So for example, let's say a company was VC backed and wants to go public. By looking through their S1 filing, you can get pretty much all the details of their previous VC fundings. You can see all the different stages of financing they went through, how much money they raised for each stage, the sort of valuation. You can get they do a really good job of trying to obfuscate things. But if you dig enough and you read enough, you can figure things out. I've actually been very surprised by what I've been able to uncover from S1 filings and other sort of regulatory filings that public companies have to put out. It is a treasure trove of information. They are very long documents. Most S1 filings are 300 pages, and there's a lot of boilerplate. But yeah, you can definitely find gems hidden within there. So that is it for my chat, my talk today. Thanks again to Ahmed and everyone involved in Medventions. I think this is a terrific program. Thanks to everyone I work at with Conavi. I work with an exceptional group, and it's a really exciting place. And thanks to my parents that were watching on the webcast. I was supposed to tug them to recognize. Apparently Carol Burnett did this when she was on TV. But anyways, that's it. So if anyone has any questions, I'm happy to answer them.
Thank you very much.
Great. So we have a question up front.
How do you see safes as an investment in medical devices?
Terrific question. Terrific. So that's one thing actually I was contemplating putting in, but I didn't. So a safe is a simple alternative for something equity. I forget what the F stands for. Simple alternative to first equity or something? Finance equity. So basically what it is, it's an agreement where the investors decide to put money in, but they don't yet set the valuation. It has a lot of properties similar to a warrant, where basically they get to, the valuation gets decided at a later date, and that just basically determines the warrant exercise price. It is becoming increasingly common. It is because SAFE is, they're just simpler documents to put together. There's less restrictions. It's one of those things where essentially you're kicking a little bit of legal work down the road. But I do know of a company actually in Toronto in sort of the health IT space that their first fundraising round was a SAFE. So it's becoming more and more common. And actually they started out in the IT space. That's where it was a group called Y Combinator that sort of invented the SAFE. A guy named Paul Graham, who's really well known in sort of the IT world. And then, yeah, but they've gradually migrated over to sort of other startups and things like that. So that's actually a great question. It's a great question. Any others? Great. Okay. I'm happy to answer questions afterwards as well. But best of luck to everyone on your entrepreneurial and other journeys.
Thank you so much,
Great.
Stefano. Another great presentation.